Okay, let's get started with our general meeting. Another Wednesday night here. How's everybody feeling? Good. Vibes are up. That's awesome. That's awesome. Emanuel sent a chat here on Zoom. He said, "Can't wait to destroy at kickball, Professor Sweet versus Mr. Damos, because it's Investment Society versus BSC. That's great. That's the attitude I want to hear." Um, yeah, Sweet, if you can show up and play some kickball here. So this is our general meeting for today. Our agenda, we're going to start off with everybody's favorite outperforming moments, the market outlook, economic outlook, M&A, sweet spot, and then several society updates like always. So first off, any outperforming moments for the week? Any recent news? Yes, one. Wow, congratulations. Yes, round of applause. Yes. Nice, congrats. It's good news. All right, one more outperforming moment. I got one. I got one. I don't got one. I don't know what I did. What? Oh, I had an interview that went pretty good with the Fed on Monday. Yeah. Awesome. All right. Thank you for reminding me of that, Alex. Today's quote is from Winston Churchill. Success is stumbling from failure to failure with no loss of enthusiasm. There's no success without a few stumbles of failure here and there, but the most important thing is to stay positive, right, guys? Really just some last.
Oh my god, yeah, I noticed that shit. Yeah, I've got these two.
Oh, okay. Some last final motivation since we're ending the semester. End strong, keep it going, and keep pushing forward. And now for the sign in, everybody scan the QR code with their phones. Remember, at the end of this meeting, we have the raffle for gift cards. So definitely stay until the very end. Thumbs up when you're done signing in. It should work. I think everybody's done signing in now, right? All right. Let's move forward with the market outlook by Juan Carlos Sanchez. Round of applause. Juan Carlos.
Hello, I hope everybody's doing good today. The market's not doing too bad, considering SVB and Signature Bank. For the month, the S&P is actually up 3.95%. It peaked today on Monday, April 3rd, at 4,124 points. And then it just went down, trickled down 0.58%. And then today it was down 0.25% to close at 4,090 points. Considering SVB and Signature Bank, pretty good. It's not negative. Now, something that happened on Monday, announced Sunday, was a crude oil surge by OPEC. So OPEC is the Organization of the Petroleum Exporting Countries, also known as OPEC. And it basically implements policies for its members, countries, and ensures stabilization of the oil market. So what they announced on Sunday was actually cutting back on production of 1.2 million barrels for the months of May all the way to the end of December. Now, this actually increased the benchmark Brent and WTI for crude oil. It actually rose. So before Sunday, it actually rose $5. It was previously at 80. And with the increase of possible oil costs and the short supply will ultimately increase gas prices. So I am sad to hear it, to say it. I hope I don't see above $4. I really hope not. Now, this in turn can actually put into effect to slow down the economy with consumers into putting their finances into their money, better managing the money. Now we got to pay gas for a higher price. We got to take either take that shirt or not take that shirt, get gas or don't get gas. Now, we could see this with airlines being a pretty big hit if the gas increases significantly, since most of the costs are actually with fuel. And oil companies or gas stations they're gonna be all right. We're gonna have to buy from them. Now, dealing with the Russia-Ukraine war, for Russia, this actually helps Russia with profit for export revenues. So for every dollar that crude oil increases, Russia gains $2.7 billion in export revenues. So this is putting more money into Russia, hopefully not prolonging the war for Russia-Ukraine, but definitely doesn't put OPEC in good standing with the USA, thinking like, hey, why would you do this? You're giving more money to our opponents, Russia. And this might propel Russia and the Ukraine war to last even further, probably hopefully not, get more ugly. Now, question, is Saudi, OPEC, helping Russia? So if they decide that they are colluding, the US actually has legislation called NOPEC, which will allow the seizure of OPEC's assets within the US if collusion is proved. Now, we also have why they decided to increase, why they decided to cut 1.2 million for barrels per day. They decided to do this over the Western banking crisis that was occurring, such as SVB, Signature Bank. And during this time, oil prices were actually decreasing. The oil prices of barrels were decreasing. I believe it went down $10. It went from $80 down to 70, 60, 68, 69. And with possible risk of losing that price, they wanted to increase the price of oil. So they decided to cut down in how much they're actually dishing out into the economy. So in turn, during SVB crisis was happening, investors would sell their risk commodities, in this case oil, for the banking crisis. And where would they put it? Maybe tech stocks, maybe in securities, in treasuries. Now, in the bottom, we actually have the American Airlines. So with possible gas increasing, this is probably going to go down either further or because they're going to have to implement all their costs from gas to their consumers. So if ticket right now costs $300, it might increase to either 400, 500. People are more reluctant to travel. And we also have Southwest Airlines, same ordeal. And on the right side, on the opposite spectrum, we actually have gas stations. We have Sunoco and Chevron. Probably not going to be too affected. They might actually increase. You can see here they're actually shooting up. And there's a small little tick on the far right side where I believe that's from Friday to Monday. So when oil has actually was being pushed out to be more expensive. Now, why tech stocks? If y'all have noticed, tech stocks have actually been rising for this year. Information technology sector has actually increased 21.96%. And that's the graph on the right side. You can see it roughly 2160 points, and then just increasing throughout the whole way from year to date. Now, based on historical movement, tech stocks actually have a tendency to bounce back after losses. So one year they might be down 15, 20%. The next year, after 12 months, they might just shoot up back to where they're at, even higher. Now, inflation hurts technology stocks. We saw this back in 2022 with the Federal Reserve increasing rates pretty high, 75 basis points, 50 basis points, almost consecutively 75 basis points. Now, you see on the bottom right, we have the NASDAQ, where most tech stocks are. You can see each year, 1981, 1984, all the way down to 2018, we see a negative return for that year. Then the following year, it just shoots back up. We have a significant one here in 1990. Tech stocks went down 18%. Next year, they went up 57%, almost triple. And when inflation reaches its peak, so it actually reached its peak back in June of 2022, last year. So once it reaches that peak, what has happened in the past, after that peak occurs, same thing happens, tech stocks tend to shoot up. And we have 3 instances here in 74. It went up 25% up after that peak, 12 months after that peak. In 1980, it went 70% up after that peak, 1990. And in June 2022, we saw that peak go down. Right now, they're up 22%. They might go up even higher to 40, 30, or they might just stay 22%. Now, with rate hikes slowing down due to the banking crisis, they're not moving up at such high levels. but they are still implementing 25 basis point increments. So what happens if they pause? If they pause, in the past, they've almost 100% gone up every time. So whenever the Federal Reserve has actually paused rates, the average increase has been 44%. And back to crude oil prices, pushing investors to get away from oil, from banks, to go into stocks that don't rely heavy on transportation due to oil increasing gas prices with increased transportation costs. So if you're Walmart, you're gonna have to pay more for truckers, more gas, more getting your items around. And since SVB, there's been articles saying, why are tech stocks safe havens? They might not be safe havens, they're probably just safe havens. Always be well diversified. Now, here we have the year to date on all different sectors and the different companies. So here we see on the top left, the majority of green. You can probably guess it, they're tech stocks. We have Microsoft up 19% from year to date, Apple up 26% year to date. And if you're in the market watch competition, this is probably the main reason that I was actually up there on 6th place. NVIDIA went up 84% year to date. And we have Google up 19%, Meta up 75%, Amazon, Tesla, same ordeal. Connect with me LinkedIn. Next we have Alex with the economic perspective.
Alrighty, today we got fiscal policy. So we're talking about the national debt, the interest expense on that debt, how we can stabilize it, a default scenario, and then some international impacts. All right, so the debt ceiling was reached on January 19. So if you guys don't know what the debt ceiling is, the debt ceiling is just a number that they set that we can't pass in terms of spending or debts that we issue. And so we reached that in January 19, and we are taking extraordinary measures to temporarily allow us to continue operations until June, which is they're considering the X date, right? And so, the problem that we're having right now is that Congress is struggling to reach a deal. The Republicans want to decrease spending, the Democrats don't. So there's kind of this, this back and forth issue, right? And so you see this chart here, this huge increase in debt. You see that huge slope right after the 08 crisis, and then just keeps increasing even with COVID. So, at some point it becomes like, how much is too much? There's also an issue here that it gets people back to 2011, and in 2011 we had a similar situation, which was a debt ceiling crisis. Now I'll talk further on that in a few slides, but this is why CDSs, there's a pickup in trading of CDSs, which is which is a credit default swap. So credit default swaps are essentially an insurance policy. A bondholder would buy a credit default swap on the company that they bought from, the bond from, as a hedge against, if the company goes bankrupt or if the government defaults. So this is basically just a hedge, right? So people are looking like they're buying more credit default swaps. So our current national debt is at 31.46 trillion. And then our interest expense, as our debt increases, our interest expense increases, and even more so with interest rates rising, right? So the probability of the U.S. default has tripled to 11.3%, right? So obviously, how many of you guys think the U.S. can default or may default? Raise your hand. No. Yeah, you think so? Okay. I mean, like, the benefit that the U.S. government has compared to other countries is that we can just print more money, right? So, and it's not like that we can't pay our debts. It's just that we politically we cannot spend more money, right? Like, so if we go into default, it would be more of a political decision rather than we don't have the funds to pay for our expenses, right? So interest expense, in 2022, we had interest payments were 475 billion, which is a 35% growth from 2021. In 2023, we're expected to reach 640 billion, which is a 35% growth from 2022. And as you can see in this graph here, our interest expenses are currently beating out other mandatory expenses and income security, and are close to passing Medicaid, CHIP, premium tax credits. So, as you can see in 2023, if we continue going in the direction that we're going, we'll have a $1.4 trillion in interest expenses, and that's going to pass other mandatory expenses, income security expenses, Medicaid expenses, defense discretionary, almost to Medicare, and then non-defense discretionary. So, as we continue to spend more and there's a debt ceiling and not take any measures to bring down our debts, our public debts, interest expense will quickly be the largest percentage of the government spending, right? And so that kind of also poses a risk or an issue, right? Because if interest expense increases, does that mean we have to decrease the percentage that we allocate to other sections of our spending, right? So, or does it mean just we have to spend more, right? Because now we have interest expense. So if we take off the percentage that we allocate to other sections of this, of defense discretionary spending, let's say, now we're going to spend more on defense, or we're going to have to spend less on defense, spend less on Medicaid just to make up that increase in interest expense, right? Or we'll just have to spend more. Yeah, it works like that, because like the Federal Reserve manipulates the U.S. Treasury interest rates by buying and selling treasuries. So if right now the Federal Reserve's increasing interest rates, and so now the newly issued bonds that the U.S. government issues are going to be at higher interest rates, and so they're going to have higher expenses to pay out, right? So yeah, that's primarily what I was going to say right here. Is just that the increase in government spending, and then combined with the federal funds rate, is causing this increase in interest expense. So this is also this fun fact here, that 50 cents for every dollar that the U.S. government will borrow over the next decade will be just to pay interest on our national debt. That's half of every dollar that we borrow will just be paid interest. So that's $10 trillion in interest expense in the next decade. So roughly a trillion a year. So within 10 years, we'll have 3.6% of just interest costs. So that's going to be more than research and development, infrastructure, and education. Obviously, I think we'd want to spend a little bit more on education and infrastructure and research and development rather than interest costs. So I think we gotta find some sort of way to bring down the debt so we can not have so much interest expense. And so this is a chart by the Congressional Budget Office, and the one on the right shows that by 2043, we'll probably pass, and net interest expense will probably pass Medicare. By 2050, we'll probably pass Social Security. So by 2050, it should, like, if we keep going in this direction, it'll be the largest percentage of spending in the federal budget. So not too much of a good thing, right? So what can we do? The Congressional Budget Office said, or they highlighted two different things that the federal government can do, which is raise taxes and cut benefits, or reduce spending. If we look at the graph here, we'll see that the green lines are raised income taxes. And so we look at the green lines and we look at the solid line at 2026. So if they raise income taxes and cut benefits in 2026, we see that, we'll be better off than have a lower federal debt to gross domestic product percentage. So if we raise income taxes by 2026, we'll be around 110% of federal debt to gross domestic product. If we wait a little longer, we'll be in the darker dotted line there. In 2031, we'll be around 120% of federal debt to gross domestic product. Now, if we waited even longer, we'll be in 2036, we'll be at around 140% of federal debt to gross domestic product. And the other thing is to reduce spending, which is just basically cutting the spending on Social Security, Medicare, and Medicaid. And that seems to work slightly better. As you can see, the dark blue line, we start in 2026, we'll be slightly under what we do in raising income taxes. Then also for the other lines as well. And I think they also proposed maybe the combination of the two, raising taxes and reducing spending. But I would say let's do reducing spending, because I do not want to raise my taxes. So I don't know about you guys. So the default scenario. If we can't find a solution, or if the Congress can't find a solution, they can always do a non-technical default. So a non-technical default would just be like they're prioritizing bondholders and stopping government spending on other things like Social Security or non-defense discretionary spending and things like that, Medicare, Medicaid. Because technically a default means that they failed to pay out their lenders, right? So they can do that, and that will likely lead to a lowering in the credit rating, which is kind of what happened in 2011. Although they didn't not pay, they just took a while and they struggled to find a certain median between Republicans and Democrats again, right? And that caused a lot of volatility in the market. As you can see here, these two charts show what happened in 2011. During that time, the S&P dropped, and the VIX, which measures the market volatility, spiked. And so that kind of created volatility. And then I think interest rates also went up as well, because the U.S. government got downgraded by the S&P from a AAA credit rating to a AA plus credit rating. So if this happens again, it also poses the risk of the U.S. government getting downgraded again. And that just means that they've now become riskier, and investors will want a higher interest rate, right, to compensate for that extra risk. So the other way is to do a classic default, right? If they do a classic default, they'll prioritize domestic spending, and they'll default because they won't be paying their bondholders. They'll just be using what they have to spend. And so what's going to happen is that the dollar value will plunge, import prices will skyrocket, right, because the dollar value plunges. And I put this asterisk near the inflation could spike, because in normal situations, that'd be the case, right? If import prices increase, then inflation would spike because now it costs more, and firms will compensate for the extra cost and increase their prices, and then we'd pay the extra prices and inflation would spike. But in a scenario like this, I think that would probably be the opposite, because now the American people wouldn't have money, right? If they would have less money, they'd be more scared in spending, and so maybe it would be deflationary. So I don't know, right? We won't know until it happens. So, and there will be also a sell-off in U.S. Treasuries, so that means the rates will rise, right? And then that'll also go to fragile balance sheets, right? So this is what we saw with SVB and with Signature Bank. With these increase in rates, increase that unrealized loss, and when they sold for liquidity purposes, they had a huge loss in their balance sheets, right? So that can lead to that, and then that will lead to firms not investing as much as well, and obviously leading us into a recession, and the dollar as a reserve currency would probably not be there anymore, right? So this is like the financial and economic impact, what would happen for the American people if we go into default. Obviously, these guys will get compensated again after a while, but SNAP, the people on SNAP, which I forgot what the acronym is, but I think most of you guys know what SNAP is. If you guys don't, it's a nutrition something program, I forgot what it's called. But 42 million people will get affected from that. Child tax credit, 60 million children will get affected. Housing assistance, 10 million people. Financial aid, 11. School lunch program, 30 million children. Social Security, 50 million residents. Veteran benefits, 10 million. Medicare, 60 million. Medicaid, 70 million. So obviously, a lot of people can get affected by a default by the U.S. government, which can translate to American people, the firms, American firms, international firms, international governments. And here this chart shows us that what the average Social Security person that is retired depends on, which is around $1,500, $1,550. And the average Social Security person with disability depends on around $1,300. And then the average Medicare, like around $1,100, and veterans disability around $900. So these are monthly payments that these people depend on, and so if the government defaults, they won't be able to get that money, and they will get hurt, and then also if they get hurt, they won't be able to spend, and firms get hurt, and the economy as a whole gets hurt, right? So it's not something we want to see happen. We don't want to see the government's defaults. So here are some international impacts, right? Some cross-border impacts. What would happen is that it will reduce access to liquid capital, right? Because people would just be frantically trying to sell their securities, but obviously the government wouldn't have enough money to pay out those securities. So a lot of people, the bondholders, which are sovereign nations or international firms, they'll hold them, would run into a liquidity issue, which will also lead to volatile exchange rates with the dollar would plummet. So people who are trying to exchange rates, so like the oil, which mainly uses the dollar, would get affected, and then also international trade, which can hamper the global trade that we have, and basically causing ships to not get ships sent out because they're having trouble exchanging that exchange rate. They can't find a median or somewhere in the middle soon enough for that, right? So that can cause backups, and that can cause that increase in import prices and export prices. So you can see in this chart that China holds about $1.113 billion in U.S. Treasuries, making up 17.3% of U.S. Treasuries. Japan is the next biggest at 1.64 trillion, at 16.5%, and there's a lot of other countries in there that hold a lot of U.S. Treasuries that will get affected by this. And so there's also, in the U.S. government default, there also could be winners. Right? And the winners who can capitalize on this or in the dollar's decline, could be the EU, right? The EU could try to get their currency, the euro, as the reserve currency. China could try to get the yuan as a reserve currency. India, the rupee, they can try to go up there. Japan as well, the yen. These are people are likely to want to capitalize on a situation where the U.S. government defaults. All right, guys, that's all for me.
Hey guys, so today I'm going to talk about how Bernard Arnault built one of the world's largest luxury and fashion empire through aggressive acquisitions. So Overview is the largest luxury conglomerate in the world with headquarters in Paris, France, founded by Bernard Arnault and established since 1987. It was originally a merger between Louis Vuitton and Moet Hennessy, which occurred after the merger of Moet and Hennessy. The luxury empire has 75 distinguished groups under its umbrella with 6 main sectors: fashion and leather goods like Louis Vuitton or Dior, watches and jewelry like Tiffany, wine and spirit, perfume and cosmetic, which can fall under Dior perfume, Louis Vuitton perfume, and selective retailing. So this is a brief history of it. In 1984, Bozark filed for bankruptcy, in which the French government was asking for a buyer to take control of Bozark and get the company profit again. And that's when Bernard see the opportunity, because he was always fascinated with Dior. And Bozark is a parents' company of it. And so he took $15 million from his family, combined with $45 million from Lazard Ferrers to purchase Bozark. And by 1987, the company was profitable again with revenue stream of $1.9 billion at the time. And the way he did this was by laying off 9,000 workers, selling many subdivisions for around $500 million beside Dior. And in 1987, Bernard worked with Alain, CEO of Moet Hennessy, and Henry, which is the president of Louis Vuitton, to form LVMH. Bernard also provide $1.6 billion to form a holding company with Guinness, which is a beer company, to have 24% of LVMH shares. After hearing Louis Vuitton Group was forming a blocking minority, Bernard wasn't happy with it. He wanted to take charge of the company to create his legacy. So he spent $600 million to buy 13.5% more of LVMH. And in January 1989, he again spent another $500 million to gain control of total 43.5% of LVMH shares and 35% of voting rights, which he was also elected anonymously chairman of executive management board. And throughout the years, he made many acquisitions toward the luxury fashion brands. In 1988, Givenchy, it was already been a part of LVMH group. And in 1993, Berluti, which is the Italian men's shoes, leather good and clothes. In 1993, LVMH acquired the Kenzo for $80 million. In 1994, Guerlain, which is a French perfume and cosmetic skincare. And in 1996, Anna bought into Celine. But it wasn't until 1996 that the brand was integrated into LVMH group for $54 million. And in 1996, he also acquired a popular brand called Louis V, a Spanish high-quality leather work. And in 1997, he expanded his market into US, take over Marc Jacob, which was a New York-based brand founded in 1984. He also acquired Sephora. And at the time, many people was doubting him for doing so. But as you can see, the success of Sephora right now. And in 1999, Thomas Pink, which is the popular high-end shirt in the UK, and LVMH paid around $30 million, 30 million pounds for 2/3 of the company. And with Gucci Group, which is LVMH competitor. So the firm had acquired a 5% stake in Gucci Group on January 6th. Even though Bernard at the time said he has no intention of taking control of Gucci, but he increased LVMH stake to 34.4% 20 days later. But then in September 1999, Kering, which is another firm, agreed to pay $806 million for the majority stake in Gucci Group. And continue into the 2000s, LVMH paid undisclosed sum for 67% owner stake in Emilio Pucci. In 2021, it acquired 33 more percent for the remaining stake. It also acquired Rossi Modera, which is the Italian fashion company. And in 2001, LVMH acquired 50% stake in a French department store, La Samaritana. I don't know how to say that, but you can say it right here. And as you can see, if you go to like French, newspaper, you can see, Louis Vuitton. They actually decorate the department very nice under like Louis Vuitton. And DKNY and Fendi and Hermes was also acquired in 2001. It acquired 89% of New York brand DKNY, then sold to G3 Apparel Group in 2016 for $650 million. And for Fendi, in 2000, both Prada and LVMH both bought stake in Fendi, but then in 2001, LVMH acquired the remaining stake from Prada. And for Hermes, LVMH was trying to take over Hermes, which is the competitor of LVMH. So initially, it's trying to acquire their 4.9% stake through subsidiaries and continue to accumulate share by equity derivative. And it keep acquiring in 2011, 2012, and then in 2013, LVMH has accumulated 23.1% in this Paris brand. But then the French financial service watchdog was smelling something that wasn't right, because LVMH said that it was trying to invest in Hermes, but apparently it was trying to buy secretly shares from Hermes, in which after the court, LVMH had to distribute its 23% stake in Hermes to shareholders and institutional investors. And by 2015, LVMH no longer held any shares in Hermes. And go further into 2010 and above, the Bulgari, which is the Italian jewelry brand that was acquired by LVMH in an all-share deal for $6.1 billion, in which Bulgari family sold their 50.4% stake, controlling stake in exchange for 3% of LVMH. And next we have Loro Piana, in which the firm acquired an 80% stake in this British footwear company. And in 2016, Rimowa, LVMH acquired 41% stake in this Italian jewelry brand, which was up by 96% in 2019. And there were three big deals in 2017, 2020, and 2021 with Christian Dior, Tiffany & Co. and Off-White, in which I want to dig deeper for the next week presentation. And let's talk a little bit about Bernard Arnault. His net worth is around $225.8 billion, which makes him the richest person in the world right now. He was born in 1949 in France. He wasn't poor. He was born in a wealthy family because his father owned a civil engineering company called Ferret Savino. And Bernard actually initially go to college for engineering degree, in which he was working for his dad's company for a while. But then one time when he went to New York City, and when he gets into the taxi, try to talk to the taxi driver, and the taxi driver was very interested in the French culture. And then suddenly Bernard was asking, do you know who's French president? Do you guys know who's French president right now? Which that taxi driver didn't know at the time. But what he know was Christian Dior. He didn't know the president at the time, but he knew what was Christian Dior. And because of that, Bernard Arnault see the vision in the brand names. And he was also obsessed. He was also in love with Dior because he know his mom was obsessed with it. And throughout the years, he found success in this industry, as you can see. And his investment strategy isn't on the short-term profit, but it's about the long-term legacy. Because he saw the potential in brand names and how it can last forever. And he also very good at talking to people and recruit talented fashion designer to work for him, like Virgil Abloh. And as of right now, Moet Hennessy, Louis Vuitton have a market cap of $25.98 billion. The profit margin is 17.79, operating margin 26.54%. And in 2018, its revenue surpassed record-breaking of $51 billion. And the revenue 12 months right now is $79.81 billion. And as you can see, China is the biggest luxury market in the world. And as people predict, it for sure will surpass the United States and EU on the luxury market. And just flex, the company is, as you can see, the company is still doing well, despite many challenges because as China is the biggest market, and during the lockdown, there was many trouble. And in 2021, the president of China also trying to encourage people to stop buying luxury goods, but the company is still doing well. And that's gonna be it. Connect with me on LinkedIn. And next we have Professor Sweet.
So I want to do real quick forecasting. I was talking about forecasting in one of my classes yesterday, how important it is in finance to be a forecaster. And one thing I want to do is encourage you, don't ignore the obvious. So if I were you sitting where you are, there's something I would do is learning economics. So what the economists say are the most important factors to look at when it comes to predicting the future. And I would say start with LEI, the leading economic indicators, the coincident and the lagging indicators. Hopefully you've heard of those. Here's the leading ones. The list is a little rough because the conference board does this and they're not real free with their information because they charge money, but you can usually get these things. So how would I do this? So why is this important? So the best economists in the world, they say these are the factors that best are predicting the future. So if I were where you are, I would first read about each one of those, figure out why they predict the future. Why are they predictive? You see the stock market's on there, the bond market's on there, obviously, but there's the manufacturing index, new orders, which is really, really important. The other thing I do, if you're taking a stats class, I don't know what your stats classes are like, but hopefully you have a project. If I needed a stats project, I would probably make the LEI my project. I would actually take the data and see how predictive it is. The issue with predictive is what is the timing of predictive? So I did this when I started my career for the ISM. I used the ISM, the manufacturing new orders. And I'd say, what does it predict? Does it predict the GDP 3 months out, 6 months out, 9 months out, a year out? What about the yield curve? Does it go inverted 6 months in advance, 12 months in advance? That would be a great project, Witten, for a stats class, to take that data and see how predictive it is, see how useful it is, and then also ask the question, is it as predictive today as it used to be? We're, what, 80-something% service economy now, so why is the ISM manufacturing an important indicator? Is it become less of an indicator? You know, that's really important stuff. The other thing you'll find is if you try to find these, you may have a tough time finding them because you got to find the exact right one. I love to just type in the index and type the word Fred so that the Federal Reserve site comes up and just look at it. You might try to build something in Bloomberg where you bring it in automatically. So you just have a dashboard, you can see where they are. So you know what the pieces are. Obviously, the stock market's up. I just read an article here recently saying, well, we'll see it here at the end, that the stock market's one of the few things in LEI that's actually coming up. Everything else is pushing down, so that's not good. Here's the coincidence indicators. That means that these things bottom out right in the middle of the recession, not before it. So they don't warn you that you're having a recession, but they tell you that you're in one. That's pretty important. And then here's the lagging ones. These are the ones that bottom out after the recession. Average duration of employment, manufacturing trade inventories. So those are ones that, those are kind of good because they bottom afterwards. So that means you see a number and you say, oh, that's a really bad number. You go, oh, but that's a lagging number. That's really good that that's a bad number because it bottoms out afterwards. If you get them mixed up, you think something's a leading indicator when it's a lagging, you're going to be panicking when you shouldn't. And so it's important to know these. So I would, do y'all get projects in stat classes? They say like pick a project. Wouldn't that be cool that they do that? Man, we should, maybe you should tell your professors, hey, call Professor Sweet. He's got some stupid ideas. I brought some of them in just to show you that you can, what I love about Fred. You see the gray bars. What are those gray bars? Recessions. Here's the LEI. You notice the LEI is dipping. And then what happened next? Recession. Notice the LEI peaked and it's dipping. Then what happened? Recession. Recession. Here's one where it didn't work. So it does predict, as they say, the LEI predicts, has predicted 12 of the last 9 recessions. So it doesn't always get it right, but what can you say? We've never had a recession without what? Without the LEI dipping. So it does always have to happen, but we don't always get a recession. But here you see it dipping. Here it dipped and nothing happened. Here it dipped and it happened. Here it dipped and it happened. What I find as amazing is it even predicts the 2021. Which everybody says, well, that's because of the pandemic. How did the LEI know we're going to have a pandemic? So it's pretty impressive. Here's the recent one. We've seen it. It's been declining pretty consistently, but it's not quite the level we saw last time, but this is a pretty sharp decline, isn't it? So people getting nervous. Here's a bunch of them together just to show where they are. So I'd encourage you, the other thing is encourage your professors. Have you ever thought about that? Hey, this is my education. Catch your stats professor on the first day. Say, hey, could we maybe have a project that we work on? And, the others don't say when the other students are around, they get mad, but, just ask them. That's what you got to do. Do some real life stuff. But I did this in my own job. I was like trying to figure out, is this really a LEI? Does it actually work? It's easy to get the data. You can get GDP numbers. You can get all of these numbers. You can bring in the stats. And what I did is I did a correlation, but I would do it 1 quarter off, 2 quarters off, and I'd see how many quarters off I have to be to get the highest correlation. You have to do a little bit of work because some of the numbers are monthly and GDP is quarterly, so you have to do a little bit of work like that. But it's pretty cool. And oh, by the way, I love this photo. Oliver took this photo. This is me on my bike in Costa Rica, and it's downhill, so I'm doing really well. Uphill was pretty tough, right? Pretty tough hills back there. So anyway. So here's what they said here recently. You probably can't read that. The LEI for the U.S. fell again in February, marking its 11th consecutive monthly decline. Negative or flat contributions from 8 of the index's 10 components. So 8 of the 10 were negative, more than offset the improving stock market prices and a better than expected reading of building permits. While the rate of month-over-month declines in LEI have moderated, the leading economic indicator still points to risk of recession in the U.S. economy. So it's just one indicator. It's not always perfect, but I would certainly, if the economists with all their knowledge say these are the best ones to look at, why try to reinvent the wheel? Use the stuff they've already discovered. All right, that's it for me. Hopefully I caught us up a little bit on time.
Awesome. Once again from Professor Sweet and our presenters. Continue with today's meeting. So for the semester outlook, we still have quite a few events left. Now you can notice there's a lot more highlighted. So we have 2 more meetings. Next week is our general meeting, and then the week after that are elections. So those of you who are interested in running, I will be talking about it in like the next 2 slides. But as of right now, we have the Sergio Silva Scholarship due tomorrow already at 5 p.m. to Professor Sweet, you email it to him. We have our kickball with BSC this Friday, elections April 19th, like we mentioned, and the Market Watch competition is ending April 17th already. So if you haven't been trading, doing some last final risky trades, see what's going on in the markets, and an update on JP Morgan, that UTSA alum who will hopefully still be coming, has not responded yet, but we'll keep you up to date with that. So either way, be prepared and have an empty slot on April 13th at 4 p.m. for the possibility that he does come. But I took y'all's feedback and response with UTIMCO, and we verified a date with our endowment to come here and visit us in person. It's going to be the Chief of Staff, Adam Wright, coming over from UTIMCO on April 18th. The time's not on there, but I believe it's at 4 p.m. And then our spring formal again this semester at 7:30. So the empty positions available, they're all available because it's the spring semester and we're opening positions for all of fall. And something I forgot to point out last meeting was that the president, VP, and treasurer position are 2 semesters long. So you're kind of in a contract to stay with that position for 2 semesters. And then, of course, the rest of the positions are on a semester basis where those are always rerun or reelected. Yeah. So once again, submit your slides and state your positions you're running for to our UTSA Investors Gmail. And the sooner you email us, the sooner you get to present and represent why you want to run for the society, what you'll do, how you'll provide a value. This is due, I mean, the sooner the better, right? But the final cutoff is on April 19th, right before we actually host these elections. The ballot will be electronically. We're going to have like a Google form up here like we did last semester and make sure the count online meets the exact count we have in person. But for the presentation, it's 1 to 2 slides suggested. Here's some examples, and the amount of time you have allocated to present and actually promote yourself is 3 minutes tops. That's an example right there. And then here's another example right there. So definitely highly recommend it. There's lots of opportunities for development in an MD position. I know I've seen it here personally with our current MD board. A lot of them have improved and helped me a lot. And here is the RSVP for the formal. Once again, we will be celebrating all graduates, scholarship recipients, the Market Watch winners, plus free food. Actually, on the free food, I think I added a question onto this RSVP. We're gonna ask for suggestions as to like what you all want. If anybody has any like comments, you can yell it out loud right now, but we're still thinking about the food to provide and cater for this formal. It is gonna be April 26th. So please RSVP and save the date. These are the current graduates I have on the doc. So if your name is not on there and you're graduating this semester, please inform one of the MDs or myself ASAP because we want to congratulate you. And some to-dos for those who are graduating, please email us your graduate photo or photos, as many as you want, but we're going to use our judgment to see how many really fit on your slide when we present you during the formal. Your degree name, your major and minor, any honors you have, like if you're graduating summa cum laude or stuff like that. You could write like a sentence of your impact to the society, like you taught an MD class, you taught a class or sector 1 semester. And then plans after graduation. And then if you want, you can also include like a fun fact or facts. But yeah. So for this week, I know Ferris, you asked this question. You can still participate, scan that QR code to RSVP for this Friday with our kickball tournament. We're playing against who are they? I don't even know those orgs. I just know BSC, and I guess that's a frat, but we got to win against all those organizations there. Hopefully they have a trophy. BSC hasn't said much, but there's a trophy. We got to get it and put it in the FSC. So definitely RSVP and wear your shirt for that. Once you RSVP, I'll add you to the Telegram so we can get moving. Awesome. And this is the RSVP to the UTIMCO's informative session that I mentioned to you guys about on April 18th. that's a little preview to the post we're gonna put on our Insta, probably early or later this week. So if you're interested on that. He has a great, interesting background, as Carlos and I know since we interned at UTEMCO. Very smart guy. You can ask several questions. He will answer them. Definitely recommend attending. RSVP for that. I'll share that too. And then Market Watch competition updates. I think this is relatively the same. Yeah, Devin's still in second, Jacob's still first. Yeah. Second to 10. Oh, okay. Yeah, it's not too up to date, right? But it's relatively the same. Yeah, it's not too late to invest. I think if you put in something and make some very risky trades. Oh, yeah. Make some very risky trades. There'll be plenty upside potentials. I also wanted to mention oh, never mind. I'm not going to go through all that. For our guest speakers, we actually have one that I didn't write down there. I think Equitable Partners. Okay, he might, a UTSA alum, I think his name is Ryan, works at Equitable Equitable Advisors. He asked to come and speak to a few of our members here. So he will be present at the FSC next Wednesday before our general meeting. So like at 7:20 p.m. If there's any interest on that area of the finance world, definitely show up a little early before our meeting at the FSC. Yes, yeah, I'll like recap this once he confirms. Yeah, honestly, we'll let you know next week, early next week. And I know I want to call up Juan Carlos because he has something to say for the society. I think a potential class coming up.
Okay, so Dante will start and then I'll continue after that.
So my name is Dante, and me and Juan Carlos are gonna start a class tomorrow. It's gonna be about how to prepare yourself for internships and like best practices. And we thought it'd be pretty helpful to do this semester because internships start their little application process really early in the summer. So we think that if we give y'all some nuggets and good knowledge, you can put your best foot forward in applying for internships. So, and we've had varying experiences, very different ones too. He's probably gonna talk a little bit about his tomorrow, and I'm gonna talk about mine tomorrow. And it's at 5:15 at the FSC if you wanna come and show up, support, learn a little bit. And yeah, so that's my little spiel, and he'll talk a little bit more.
And like he said, we'll cover anything from resume tips, interview tips, what industries, how to build your resume if you want to do finance with Apple or do commercial banking with JP Morgan. So it depends. And also you can ask questions. We'll answer whatever questions you have with the intention of obviously helping you guys get the internship. And like Dante said, there's a lot of internships that open right now for 2024. So you want to start applying right now so you can get those interviews and start getting better. So tomorrow at 5:15 in the FSC.
And also, if you come, ask a lot of questions. Like you can even message us on LinkedIn. Well, can they message you, or you don't want to? Don't message him, but you can message me. And just, nah, he's kidding. You can message him too. But you can message us. Come to the class. Ask a lot of questions. We're here to help. We really just want to like show that like no matter where you go to school, you can get any internship possible, and we think it's possible if you put the best foot forward. So just be proactive. Ask a lot of questions. But yeah.
Thank you.
Round of applause. Good stuff, good stuff. And now for the better stuff, the gift cards, free money.
All right, guys, can we do a drum roll, please? First name I have is Victor Rodriguez.
Is he here? Oh, congratulations. Yeah. First winner.
All right, so the second name I have is, drum roll, please. Melissa Walter.
Okay, congratulations. Awesome. Yeah, the gift card winners can come down here basically right now because we're done for today. Thank you all for joining us and see y'all next week. Stay up to date on our socials and attend those guest speakers that are coming down like UTEMCO.